In our previous update in November, we spoke about the renewed hope we had seen for the global economy in 2021, following the breakthroughs made with regards to finding effective vaccinations for COVID-19. We continue to see a ramp up in vaccines across the world, resulting in a significant share of populations being fully or partially vaccinated against COVID-19. As mentioned previously, vaccine penetration rates differ by country, and that will inform how quickly various economies recover coming out of the pandemic. Developed economies have made significant progress with vaccinating their populations, while developing economies like South Africa continue to lag. Nonetheless, the vaccination progress supported the rebound in economic activity that we started to see last year, which was equally positive for the real estate sector during 2021 in terms of improved leasing conditions, improved cash flow generation, and depending on the region, improved transactional activity. On the back of that, we saw a strong rebound in real estate equity markets globally and locally beginning in November of 2020, and that rally was carried over into the 2021 calendar year. On this chart, we show the performance of the South African listed property sector relative to other asset classes during 2021. For the period ended December 21, listed property delivered total returns of 37%. Almost all these returns we've seen so far were driven by the correction in share prices following the sell-off that we saw in 2020. And if you consider returns from when this rally started in November of 2020, listed property is up 60%. There is a huge margin of outperformance relative to other asset classes, and it also indicates that the sector was oversold throughout most of 2020. For us, the other important reminder out of this is that there will always be periods of volatility in the markets. But the most important thing to do during periods of volatility, which admittedly is quite a difficult thing to do when one is going through those moments, is to remember your long-term investment objectives and to remain invested. Looking forward, we think that the probabilities of seeing these kinds of returns repeating itself again in 2022 are low. Our view is that fundamentals of real estate demand and supply, not a correction in share prices, will dictate the direction and performance of the sector going forward. So coming off a period of strong listed property market performance in 2021, there are three questions we want to answer with this slide. How has the listed property sector performed in the first 2 months of 2022? How does that performance compare to the first 2 months of each year since 2003? And can we draw any conclusions in terms of how the sector will perform for the rest of the year, given how it starts the calendar year? So on this chart, we show how listed property performed during January and February of each year beginning 2003. I think what is clear when one looks at this chart is that there have been 8 periods in the last 20 years where listed property started the year with negative returns. With the recent market events in the last few weeks, firstly around concerns about the impact of monetary policy tightening on equity markets, and secondly, on the geopolitical risks we have seen around Russia's invasion of Ukraine, the South African listed property sector has sold off by about 6%. This makes this year's performance the third weakest start to the year we have seen in the history of the listed property sector. The most negative start was in 2020 as a result of the COVID-19 pandemic, followed by the sell-off driven by the governance issues which affected some of the listed property companies in 2018. So if we look at history, periods which started off on a positive footing have historically ended with the sector delivering positive returns for the year. However, in the last 19 years, we've only had 3 periods where listed property started off the year on a negative footing and went on to close the year with negative returns. This was in 2008 during the global financial crisis, in 2018, and in 2020 with the COVID-19 pandemic. All other periods where the sector started the year with negative returns ended with positive returns for the year. But this is by no means an investment thesis into the listed property sector, but a reminder that in the last 20 years, we've only had 3 periods of negative returns from listed property in a calendar year. And that is because dividend yields act as a buffer when capital returns turn negative. The higher the starting dividend yield, the bigger the buffer against potential capital losses. Today, we estimate that the sector trades at a forward yield of approximately 8% compared to the average of 6% between 2010 and 2017. If we turn our attention to some of the big picture trends we've observed in the global real estate sector in 2021, we start with the Commercial Property Sentiment Index, which measures sentiment on occupier demand and investor demand. You'll notice that as economies reopened, That brought with it an improvement in sentiment from tenants and investors into the asset class. Sentiment in some regions such as the US and Europe recovered strongly, with some regions such as Middle East and Africa only managing to catch up in the last quarter of 2021. Interestingly, the positive momentum continued well into the fourth quarter of 2021, driving the index to positive territory for the first time since the onset of the pandemic, despite concerns around the Omicron variant. We've also seen some encouraging developments on the leasing front in the office market. This chart shows total square meters that were available for leasing in the first 3 quarters of 2021, for which lease agreements were reached between landlords and tenants. If we compare leasing volumes achieved in the first 3 quarters of 2021 with what was achieved in the first 3 quarters of 2020, you'll notice that the volume of leases in 2021 were 39% higher than the comparable period in 2020. While this is positive, and while we expect to see an improvement again this year, we think that it will take a bit of time for this office market to find its footing. What surprised most of the market participants last year was the sheer volume of transactions that took place in the global real estate market. After transactional activity paused when the pandemic hit, we saw a decent recovery in 2021 as visibility improved. Transactions were led by the US and Europe, which are markets with very deep liquidity. In the US, we saw transactions clearing at property valuations that were higher than pre-pandemic levels, while markets such as South Africa were relatively quiet. Overall, transactions during the third quarter of 2021 were 4% higher than the same period in 2019. Although we've seen very encouraging trends on the global office leasing market, some office markets such as South Africa remain weak and will likely take longer to recover from the pandemic. As far as leasing volumes are concerned, last year's leasing volumes remained at historically low levels. That was in part driven by the slow rate of vaccinations we've seen in South Africa, coupled with tenants taking longer to commit to office space requirements. Due to the weak trading environment seen over several years in the country, not only are we seeing tenants returning office space back to landlords as a result of their businesses failing, but we're also seeing corporates gradually reducing their space requirements as a way of managing costs. And that is achieved by tenants reducing space when leases expire or subleasing their space to other tenants. Looking at the fourth quarter 2021 office market reports, vacancy rates in the South African property sector reached an all-time high of 16%, leading to approximately 3 million square meters of office space being available for leasing. To put that in context, there is approximately 5 square meters of space available per 100 inhabitants, compared to 3 square meters per 100 inhabitants when vacancy rates were almost at the same levels back in 2003. The recovery we have seen in the retail shopping center market has been very encouraging following the challenges that the sector experienced due to the pandemic. We have continued to see a recovery in both the number of visits to shopping centers, as well as sales levels achieved by tenants operating in those centers. If you look at some of the recent results reported by REITs, we've seen that although footfall is yet to recover back to 2019 levels, the level of sales achieved by tenants have surpassed the 2019 levels. In terms of our preference in the retail property space, we continue to prefer to have exposure to property companies servicing middle to low income consumers, which operate in townships and locations outside of major urbanized areas. Shopping centers in these areas were impacted the least by the pandemic and recovered quicker coming out of the lockdowns, given the high proportion of value and non-discretionary products sold at those centers. We've also seen them outperforming regional and super-regional shopping centers, which generally have a higher allocation of tenants that sell discretionary goods. As mentioned in November, the resilience of some of the township retail shopping centers were down by the unrest we saw in parts of KwaZulu-Natal and Gauteng provinces in July. However, good progress has been made in reopening most of the shopping centers that were damaged by the riots, with a few that have not been opened yet planned to open throughout the course of 2023. This slide captures the state of the South African real estate market and largely informs how we have chosen to position our portfolios. It looks at the rate of growth in rental income each year since 2013, after taking into account the impact of rent renewals, vacancy rates, and operating costs. So back in 2013, our rentals were growing at a rate of 5% on a net basis. As a result of the weak economy, the fundamental backdrop for the real estate sector in South Africa has also been gradually declining, with effective growth in rentals approaching 1% prior to the pandemic. The backdrop we've painted informs our portfolio positioning relative to our benchmark. While the SA market is weak, there are JSE-listed property companies that operate in regions with high economic growth projections and favorable real estate demand and supply dynamics. We can invest in these property companies to mitigate the weakness we see in some South African property companies. So if you look at the positioning of the portfolio relative to the All Property Index, we think that some REITs and property companies operating in South Africa and the UK face several headwinds, which makes us less excited about some of those opportunities. On the other hand, we are overweight companies operating in Central Eastern Europe, Germany, and Australia. Our entry point into Germany is through a leading owner and operator of business parks, offices, and industrial complexes with a strong track record of shareholder value creation. The resilience of this company's business model was tested during the pandemic, and our portfolios continue to benefit from the company's robust operational performance, which is translating into strong shareholder returns. In the CEE, we are exposed to Nepi Rockcastle, MES, and EPP, which are all retail-focused property companies. These positions were taken with the view that these companies would benefit from the high economic growth in the region relative to Western Europe and South Africa, high consumption expenditure, low levels of unemployment, and limited supply of real estate space. These factors are all positive for real estate demand and rental growth. It is safe to say that we do not have any exposure to assets in Ukraine. However, these property companies own real estate in Poland, Romania, Slovakia, and Hungary, which all share borders with Ukraine. While the economic linkages between these CEE countries and Ukraine are low from a trade perspective, the economic weakness that we'll see in Europe because of this crisis will affect the CEE economies as well. That said, our hearts are with the people of Ukraine during this crisis.